what are the different funding options, approximate kind of cost ranges for those different funding options, as well as some risks and benefits? Do you want to just take us through the options as you see them?
Absolutely. So there's lots of different options available. Like if we talk about options now as actual loan or credit products and not optimizing working capital or not using your 401k, for example, there's lots of different options. I would typically categorize them in sort of two sections. Like, we have short-term time financing products and we have long-term type financing products. Like the short-term financing products tends to be, cheaper because lenders are taking less risk. This is typically your ABL facility or something like that where you're using your stock or your debtors book, receivables, to finance working capital often. And then you have these longer term loans, cash flow loans or EBITDA loans, for example, as I would call them, which are typically then used for, let's call it, long-term investments. These different products sort of become available to companies at different stages depending on their size and their profits and the size of their balance sheets typically. We've talked a lot about revenue-based financing, right? Generally, these products have payback periods between sort of 3 to 12 months. In terms of cost of capital, they would be typically between sort of 20 to 30% interest. What to look out for with these ones? Yeah, I would say make sure that you understand how they impact your cash flow and that you understand what the true cost of capital is. Moving on, let's talk about asset-backed financing, or often called ABL, asset-backed lending. This is typically something that is used by e-commerce companies when their balance sheets become a little bit bigger, and hopefully it's the asset side of the balance sheet that is growing predominantly, meaning that they have more inventory or more receivables that they can leverage and offer as security to a lender. And because they're offering some sort of security that can be liquidized in an unfortunate sort of situation, but the lender can offer you a much lower cost of capital. These products are typically sort of 2, 3, 4, 5 years, often with an interest-only structure, meaning that you're not amortizing on this loan, so they act sort of as a bullet, and often they're renewed once they come to the end of the term. In terms of what to look out for, I mean, because they have a lower cost of capital, they will put in different types of covenants to make sure that your business is in a healthy state. So you need to make sure that you can meet covenants, that you have sufficient amount of borrowing base, i.e. you're not taking out money and then your borrowing base, i.e. your inventory or your debtor book, dramatically decreases, which then will make the lender tell you, hey, you've borrowed, X amount of capital, but you only have Y amount of assets available. You need to kind of fill this gap and pay us back. I would say any company who has, sort of $2 million or dollars, pounds, or euros, worth of inventory and receivables can get an asset-backed facility